Hello, everyone. Nice to meet you again in the series of lectures that I'm preparing for uh, finance finance topics, a series of finance topics to be discussed. And today we plan to talk about individual assets, returns, and risks. So it's very important as well as interesting because whenever you invest your money, your wealth into certain investment vehicles or investment instruments, you need to always measure or calculate or estimate your return and risk. So let's start our discussion today. Okay, so we'll start our discussion with the concept of return. I think we start from a good one instead of risk. So we start with return. As you know, again, whenever you invest your money, your wealth into any investment instrument, any uh, investment products that could be found in the market, then you always estimate the return, right? And if you measure return that has passed or return that has been earned, so we are saying that this is what historical return. This is a historical return or ex post return. So whatever your investment products that you chose to invest in, the the measurement or the estimation of return always follows the same principle. So return can be measured as your proceed divided by your initial investment. So this is a common principle for any type of investment instrument. Now here's the thing, right? The form of proceed might be different from one investment instrument to another. So the form is different, but again, the principle is the same. So let's take an example. If you invest your money in the time deposit, so time deposit, uh, it's very famous. Almost everyone has a certain amount of wealth invested in the bank as time deposit. So if you invest in time deposit, obviously you're expecting the interest income, right? Interest income from the time deposit. So the proceed would come from the interest income. What about if you invest in a bond, when you buy a corporate bond or even government bond, right? So if you, for example, if you put your money into a corporate bond, what do you expect? Of course, the coupon, right? The promised coupon. So the coupon income, now you also expect the bond price to increase. So you're expecting the capital gain as well. So you have coupon income and also capital gain to be earned from your bond investment. So the proceed will be in the forms of coupon income and capital gain. What about stock investment? If you buy a stock of a certain company, then what do you expect? Of course, you hope to earn what, dividend income, right? You're waiting for the dividend income, but you also look forward to the stock price increase or capital gain. So you might receive dividend income as well as the capital gain from the increasing stock price. So again, one more time, proceed might be different or comes from different form, but in principle, you expect or you want to get some proceeds, right, from your investment. So proceed divided by your initial investment, then you get your percentage of return, right? Certain percentage point of return. So let's see an example. assume or suppose you bought any stock, maybe Bank Mandiri stock, right, with an initial price of 4,900. If you notice, currently the stock prices of Indonesian companies have plunged because of the crisis situation, like the health crisis. So initial price of 4,900, and suppose during the holding of the stock, you earn dividend of the 300 a piece, 300 per share, and when you sell it, maybe a month or 2 months later, the selling price is 5,500. So what is your return? It's quite easy. So your return or your historical return should be, what do you earn again? Dividend income of 300, right? And then you also get what? Capital gain from 4,900 to 5,500. So you gain 600 is your capital gain divided by your initial investment, which is 4,900. So it's 900 divided by 4,900, and I'll calculate quickly using my calculator. So it's 18.37%. So 18.37%. Right? So this is your return. And because it has happened, we call it ex post return or historical return, because it has happened. Okay, I hope it's clear. So now we'll delve into a very important concept in finance and economics. So if you want to estimate your historical return, you find uh, a little difficulty because the historical data might be available, and if this is your own investment, obviously you know the initial price or the initial investment, and you know how much you have earned from the investment, okay, and then the selling price and so forth. However, when we try to measure an expected return, this is something to be expected. It hasn't happened, so we call it that ex ante estimation. See, right, for in economics, in um mathematical economics, in statistics or anything, the expected value of something is of big interest, right? So in this particular case, we are talking about the expected return, right? Expected return on an investment. So to gauge the expected return, we have at least two major approaches. The first method is the scenario building or scenario analysis. So as the name suggests, you can guess easily that in the scenario analysis, of course, we have to build scenarios, right? We have to create certain scenarios, right? To estimate the expected return. And the second one would be the historical method that we'll see later. Okay, so let's start with the first one, right? The scenario analysis. And in scenario analysis, we have to build scenarios, and of course, in the most simple form, we might have like 2 or 3 scenarios. But with the improvement and advancements of technology, even now we can have maybe 10,000 scenarios with the Monte Carlo simulation. However, Monte Carlo simulation is out of our scope for today's discussion. But you can find out on Google or on the computer text and any other sources is quite convenient, right, in the modern time. So to run any bootstrapping method, Monte Carlo simulation, and so forth. But for the sake of brevity, we'll use simple scenario analysis. Okay, let's say we just make maybe 2 or 3 scenarios. Let's make 3 scenarios. So we're saying that we are estimating, our research team, our internal finance and economics team, or any uh, strategic planning team or anything, right, are estimating this. So if the economic situation is normal, let's say we would expect a return of 15%, maybe, 15%. So if it's better than normal, say we would earn maybe 17. And if this is really good, excellent, maybe we earn 20%. This is just again an example, right? But if it's not that good, right, we might have to go down to maybe 5%, right? And which is really bad, right? Bloody bad. Um, we might lose 2%, right? Get the loss. We might make loss of 2%. Okay, so these are the projected returns based on the scenarios that we have created. Again, in real life, your research team might be able to make maybe 9 scenarios, 15 scenarios, or even 1,000 scenarios with the help of technology, right? With the advancement of information and communication technology. Okay, so back here. So we have the projected returns, right? The returns, the scenario-based returns. So because we are using the scenario analysis, we also need to conduct research on their probabilities, or the probability of each expected return. So probability for each. Again, this is based on our research, right? The what's that? The policy making research or applied research in our company. But again, this is an example, simple example. So I would assume that the normal situation will have the highest chance of happening. Let's say this is at 50%. Again, I choose the number randomly, arbitrarily, without any logic, because again, this is an example. So we can say that all the numbers here come from the sky, because we didn't conduct any research whatsoever to come up with those numbers. So let's assume again that the other four scenarios have the same probabilities of happening. So the remaining 50% divided by 4, so 12.5% each. Okay, so now we have a return and probability. So then how can we estimate the expected return using the scenario analysis? Expected return using the scenario analysis would be your projected returns. You see the ith R. So this is what, 20, 17, 15, 5, minus 2, right? Multiplied by its respective probability. Then we sum them together. Right? Quite simple. So you see the Excel here. If you do it manually, it should be what? the first projected return in the excellent scenario, 20% multiplied by 12.5, right? Plus 17 multiplied by 12.5%, and so forth, right? Plus 15% times 50%, and so forth, right? So we sum them together. So in Excel, it's much easier. So we have each multiplication. So the first line for the excellent scenario is 20% times 12.5%. And of course, the second row would be 17% times 12.5%, but we can make a copy and paste mechanism, right? Have the same pattern, okay? And then sum them together. Okay, we find out that the expected return on this investment is 12.5% based on the scenario analysis that we have created. Okay, quite easy. So once again, is the projected each projected return multiplied by its probability, and then we sum all of them together. What about the second item? So return and risk, right? They always sound like a pair. We know the famous investment a conventional wisdom in investment that says the higher the risk, the higher the expected return, right? So high risk, high expected return. So that's, I think, more appropriate than saying high risk, high return, because nobody could guarantee that. So if you do something or you invest your money in something, of course you expect the return or the reward corresponding to the level of risk that you have taken. I suppose you invest in government bond or government securities, risk is relatively low, or even we could say that it's almost risk-free, or you can even say that it's risk-free in many situations. It's risk-free. So if the risk is very low or almost nothing, then the expected return, of course, would be quite low or moderate. Right? However, if you invest your money in into the stock market, if you buy, even stocks have different levels of risk. Right? If you buy the relatively stable company stocks, then you'd probably expect moderate level of return. If you buy the really risky stocks, then of course you expect higher level of reward or return. Right? So it's the conventional wisdom saying that high risk, high expected return. Right? So again, one more time, it's more appropriate to say higher level of risk is followed by higher level of expected return, other than saying high risk, high return, because nobody could guarantee that. Or even if you decide to work at like a certain company, or you become a businessman or businesswoman in a certain industry, even you are taking a certain educational program like a CFA program, you take the time for it, and of course, by taking the time for it, you're faced with like certain types of risk, right? Maybe the opportunity cost that you have to suffer, or you have to sacrifice, health risk, because you have to prepare for exams, right? You have to prepare for the studying, and then taking exams, and so forth, right? So simple question, right? Once you finish the let's say the CFA program, who can guarantee that you get maybe tenfold salary that compared to the one that you're having right now? Nobody could guarantee that, right? Nobody could guarantee. So I think the best we could say is a high risk, high expected return. So by taking a higher level of risk, of course, you expect something higher or something better than that before you took the investment or you took the time to do something. Okay, so the second component is risk, right? So in economics, uh, uh, as inspired by mathematical statistics, we always use standard deviation as a measure of risk. And of course, before we get the standard deviation, we get the variance, right? The variance, again, is the uh, standard deviation squared. So the square root of variance is the standard deviation, which is the proxy for risk, right? The common proxy for risk. So what is variance? And variance, as the name suggests, see variance, and then the square root of it is standard deviation. So it measures the deviation, right? Measures the deviation. Deviation from what? Deviation from the expected value. So in our case, it's a deviation from the expected return. Okay, so now we have got our expected return in our previous calculation at 12.5%. So what is our variance now? And the variance, again, this is the standard deviation squared. So deviation talks about, once again, deviation from the expected return. So we see each projected return, and in our example would be 20, 17, 15, 5, and minus 2, right? Minus the expected return, right? So that's why we call it the deviation from the expected return. Uh, However, we cannot simply add them together. Because when we add them together, you can imagine, right? This is the items projected returns. Well, this is the average value or the expected value. When we sum them together, of course, the result will be zero because some of them will be above the expected return, some will be below, and when we sum them together, it's like averaging out and the result will be zero. So before we add them together, we have to square it, and then we multiplied each projected value with its probability. Then we sum them together. Okay, so take an example here. You can see the first line at 20, at 20% minus 12.5%, right? So the first line would be 20% minus the expected value and square multiplied by the first probability for the excellent scenario, 12.5%, plus the second row and so forth, right? The third row and so forth. So let's use the Excel. It is simple. So for the first line, what is it? 20%, right? Minus our expected return. Be careful when we do the copy and paste. Remember that below the 12.5% is nothing. So below it is nothing. So we need to lock the value. Right? Then we square it. Then we multiply it by the probability. It's probability, right? Okay, so we can do copy and paste, but maybe we can try the second row before we do the copy and paste. So second row, 17% minus the expected return. Again, one more time, we have to lock it because below the expected return is nothing. Okay? So we square it and then we multiply it by its probability, right? Okay, so doing the copy and paste, right? And then we sum them together. So up to this point, we get variance here with the variance, and to find the risk, we do this square root of this, right? Square root of, so you can use SQRT, you can use the to the power of half, is the same thing. So again, we find the square root of this, so we get 6.78%. So this investment, this investment has an expected return of 12.5% and a risk of 6.78%. So now you might be asking, what is the main purpose of estimating or finding its expected return and risk, right? So what's the meaning of the calculations and estimation that we have been doing? So this is very important, right? By knowing the expected return and risk, actually we can make a confidence interval, like what you have learned in statistics. Right? So from the information, we know that the expected value or the expected return is, what is it again? 12.5%. And you remember our discussion just now is that risk or the standard deviation is the potential deviation from its expected return. So you could imagine now in your confidence interval, it's like we could make estimates, right? So swinging to the left, swinging to the right is potential deviation from the expected return. So we could put it this way. At this point, right, we could make an estimate here. We can say this is like maybe the worst scenario or the bad scenario here, the farthest to the left. So this would be what? Your expected return minus your risk, right? Your standard deviation, right? However, because we are talking about the confidence interval involving a certain type of distribution, and of course, for this example, we are using the normal distribution or the Z distribution. Of course, we have other distributions like T distribution or Bernoulli distribution and other things. But in the simple example here, we are assuming the Z or normal distribution. So because this is like statistical thing, right? That has statistical properties, then we need the coefficient on the sigma. Now, of course, you don't need to memorize anything because now you have Excel. Can go to Excel to find if you want like the confidence interval of whatever 90% or 95%. What is the Z value? You can do it easily in normdist function on Excel, or you can find your tables or anything. So we need a coefficient on the sigma to represent the confidence interval. However, this is the thing. There are certain numbers that we accidentally memorize because we use them a lot. Again, one more time, I don't recommend you to memorize all the numbers here, but there are certain numbers that because of the intensive uses, then we accidentally memorize them. For example, I could write here 165 165 sigma under the Z distribution. This corresponds with 90% confidence level. Right? And then 196 is 95% confidence level. And then maybe 233, this conforms to 98% confidence level. Then 258 shows a 99% confidence interval. Again, I think we should not memorize any numbers, because now we have, again, the technology. We have like extensive, capability of even your Android, your Apple, right? Let alone your Excel on your laptop and other things. But we are saying here is that what we are saying here is that there are certain numbers that we use them a lot, such that we accidentally memorize them. So let's use an example here. Let's take an 95% confidence level. So 1.96 is the coefficient. So to make it easy, I will write 2, right? Yeah, 2 is quite close to 1.96, so it's okay. So 12.5% minus the coefficient is 2, and then our standard deviation is 6.78%. So I will calculate quickly. 12.5% minus 2 times 6.78%. Okay, so we get minus 1.06%. Okay, so what about the right swing? Okay, the right swing. So see now the same analogy, congruent situation, but to the right. So this should be expected return plus sigma, right? Sigma is our risk or standard deviation. And again, because we choose or we have chosen the 95% confidence interval, so this is supposed to be 1.96, but I will write 2 to make it easier to calculate. So 12.5% plus 2 times what is our standard deviation again? 6.78%. So let me calculate quickly. 12.5 plus 2 times 6.78%. So it's 26.06%. So what can you infer here? This investment has an expected return of 12.5%, with the worst scenario of minus 1.06%, and the best scenario is 26.06%. And what we are talking about here has the possibility of 95% correct most of the time. 95% of the time. Okay, one more time. So the expected return on this investment is 12.5%, with a left swing, or the worst scenario, of minus 1.06%, and the best scenario of 26.06%. And what we are concluding, what we are talking about here has the probability of the probability of 95% of the time that it is true, right? But the statement is true 95% of the time. So you can see our discussion here is not our main topic today, but you can see that the higher the coefficient, the higher the confidence interval, right? So the higher the probability of truth about what you are stating or what you are saying. And if you remember, I think maybe about 2 decades ago, uh, there was a very famous terminology in the field of operations named Six Sigma. So now you could imagine, right? Even 2.58 sigma has a confidence interval of 99%. So if we are talking about Six Sigma, this would imply 99.999999%. So it's essentially almost perfect, right? So maybe we are saying that in the manufacturing of something, maybe manufacturing of an LED, out of 1 million LEDs that we produce, we only allow maybe 1 or 2 defect products. So it's almost perfect manufacturing process. So we call it a Six Sigma. Right? I think General Electric was the first, or maybe among the first company who popularized the terminology, the Six Sigma. And even I think they offered from green belt to black belt or something like that, right? As a certain certification of the quality assurance program. However, maybe not every field is interested in the higher coefficient. Of course, in manufacturing, we know we want a higher coefficient to improve or to enhance the quality assurance. Maybe in the health, same thing prevails in the health industry. If you make a certain product, maybe for the flu virus, out of maybe 1,000 people that you tested, of course you want that all of them are safe and suffer from minimum or minor side effects. Right? So you want almost 100% safety for the medicine. However, certain fields might be more interested in the precision rather than the wider confidence interval. So interestingly, one of that field might be economics. So let's imagine this scenario. Let's say you have a neighbor who is an engineer or a biologist or any other profession. So your neighbor is asking you as an economist or a finance practitioner, right? A finance practitioner. Uh, so in your expectation, what would be the range of economic growth for Indonesia this year, right? And you could give a range. If you could give a range, let's say you're saying like maybe 2 to 4%. Again, because of the health crisis, at 2 to 4%. Okay, 2 to 4%. You see that this answer is very narrow, right? 2 to 4%. It's narrow but very interesting. So it looks it looks sophisticated. It looks logical, right? From 2 to 4. However, because the confidence interval is so narrow, it might get wrong easily. Let's let's say that at the end of the year we find out that the economic growth of Indonesia this year is 4.5 of even 4.25%. Then your statement is not correct, right? Or yeah, maybe the negative side, maybe 1.75%. It means that your statement is not right either. Not right either. Okay, so it might get wrong easily, right? Might get wrong easily. However, this answer looks sophisticated and it shows precision, right? It shows that when you give your projection, you give your prediction, you have like certain, or you have the precise range that you can offer to be your client or your company or even your neighbor. What if you answer this way? You're saying that the economic growth of Indonesia this year would be between 2 to 50%. Then the confidence interval, you can see here, the confidence interval is so wide that any number could be correct, right? Based on your statement. So 2 to 50 means if the reality is 10%, then you are right. If the reality is even 15%, then you are right. Right? If the real economic growth is 30%, you're also right. Right? If the real economic growth at the end of the year is 3%, then you are right. So almost all numbers, almost all possible numbers are right based on your statement, right? So this statement will enlarge the possibility of truth, right, for your statement. However, this is not precise. So the precision is low, right? Precision is low. So in certain fields like economics, people might be more interested in precision rather than the wide confidence interval or the probability of truth. It's quite interesting, right? So very different from the fields of maybe manufacturing or operations or healthcare industry or some other things. So there's always a trade-off between the confidence interval and the precision. Okay, now we'll continue with the second approach. You still remember the second approach is the historical approach, historical method. Okay, for the second method, this is actually a much easier method, and of course you can be more relaxed in making estimation because you don't need to build any scenario. We just need to get historical data on our previous returns, maybe for the last 12 months, for the last 5 years, for the last 10 years, and so forth. So the historical method now, the historical method. So again, the first approach was the scenario analysis, our historical method. So in the historical method, again, we don't build any scenario, but we need to collect our historical data. So let's assume that we have the previous 12-month returns, right? And so we mentioned random numbers. So annualized monthly returns, say anything maybe 5%, 15, right, -3, then 20, 11, 9, and then 12, right, 0, and then 10%. How many already? Yeah, 3 more. Maybe 15, and then 3 and 12. Okay, so I have 12. So we are using random numbers actually, but we assume that they are our previous or historical returns. Right? So expected return, again, they have happened. See, these are historical returns, so they don't have any probability of happening anymore. We don't need to make the projections of their probabilities because they have happened. So expected return using this method would be much easier. Expected return would be the projected returns. We have projected returns of 5, 15, minus 3, 20, 11, 9, 12, and so forth, right? So we sum them together because they don't have probabilities. They have happened, right? Sum them together and divide it by the number of observations. So what is it? This is to calculate average, right? Or mean, right? Average of something. So it's very easy. Again, we don't have probabilities for the projected returns anymore because they have happened. So expected return based on the historical method. So this is the average. Okay, so the average return is 9.08%, right? 9.08%. Okay. So what about the risk using this method? So in a similar fashion, right, the variance. If you still remember, variance is the squared standard deviation, deviation squared. So it measures the deviation from the expected return. So we have each projected return. Once again, projected returns are 5, 15, minus 3, 20, 11, and so forth. Minus the expected return in our example. And we just found our expected return, and it is 9.08%. We square it. However, now we don't have probability, right? Because each projected return is based on historical return, so we don't have the probability of happening because they have happened. Then we sum them together. Now we divide it by n minus 1. I know this is this should involve a long discussion in econometrics, so it's not the scope of our discussion today. If you divide it by n, it's still unbiased, but maybe not best, right? But if you divide it by n, this is asymptotically correct. Asymptotically correct means if the n increases or the number increases, number of observations increases, then we'll get a relatively, closer number to the unbiased and best measure. So let me give you an example. So if something is divided by n, right, and the same thing is divided by n minus 1, so it depends on, sorry, let me rephrase my statement. Let me give you an example. If a certain number is divided by, let's say, 3, right? Certain number is divided by 3, and that certain number is divided by 3 minus 1, so 2. What do you think? Will the results similar or far away? Of course, it's far away, right? Because the n is small, right? The number of observations is small. So you can imagine if this is 10, right? 10 divided by 3 is 3.33. 10 divided by 2 is 5. So they're totally different or far away. Right? However, can you imagine a certain number is divided by 1,000, and that same number is divided by 999. So I suppose the results will be not too far away. Of course, they are not the same, right? They will not be perfectly the same, but I suppose that the numbers might not be that far away compared to our previous example. So you can see here that if you divide it by n, we call it that it is asymptotically correct. So if the n increases into a higher and higher number, then n then the measure of the variance using this method will be closer to the unbiased and best scenario. However, if the n is not that big, of course we have to use the more appropriate denominator, and the more appropriate denominator is n minus 1. This unbiased and best. Okay, so we go back to the Excel. And of course, because this is a historical method, we don't even need to make a new column or new cell, because we can simply use the standard deviation, right? The standard deviation of the historical returns, and we get 6.69%. So using the historical method, we find out the estimates of return, estimates of the expected return of 9.08 and risk of 6.69%. Okay, so we have I think we have completed pretty much our discussion on individual assets and individual assets returns and risk. If you have any question, we can discuss it further to the YouTube channel or maybe other means of communication. And yeah, thank you very much for your attention and your visit to the YouTube channel. I will continue our discussion to the next topic, which is the portfolio formation or the portfolio context of the investment. This is continuation. Today we just saw the individual assets return and risk. So for the next one, we'll combine more than one asset into a portfolio, and we'll see how the portfolio return and risk be formed as part of our investment strategy. Thank you very much. See you next time.